My name is Johannes Benini. I'm the chairman and founder of the JBC Energy Group. David Wech is the managing director of JBC Energy in Vienna. Let me just remark, with all the services we have, you have seen before you came in, or when you came in, a little bit of a PowerPoint animation that refers to our online services, where everything is online, where you can also see the latest blogs. So obviously we also do have regular feeds every day, not every hour, but constant feeds with short analysis that is online available. Eventually it will pop up in some of the reports, but obviously that's all going much faster nowadays. So those of you who are interested in that, please be mindful of that. 25 years, yeah, we founded the company, I founded the company 25 years, so it's a quite nice journey we have been going through. I guess most of you are familiar with us, so I don't need to talk too much who we are, but we provide research services and consulting. The presentation that we have prepared for you, as I said, David and I will do this in a double conference style. Do we have Chatham House? Do we do this, or?
Let's say yes.
Okay, David says we have Chatham House rules, so you can enjoy everything, but be careful about whatever is being stated outside from here. You know, it may be misinterpreted. So let's keep it simple. Enjoy the presentation. Let me start with the key messages for you. We're starting because, you know, we're Austrians, right? We're trying to be as good as the Germans when it comes to punctuality, despite still people are pouring in, but we are mindful of the fact that your time is precious to us. Let me start with the key messages for you. When you look on this graphic, you can see that the gray bars moving higher in the last years, from 17, 18, and now 19, they represent light crude oil and condensate supply. You see the orange bars that are pointing lower, that shows you the change in the medium crude oil supply. And that's one of the key drivers of today. We have more and more light crude oil, obviously associated with shale oil and the likes. We have less medium crude oil. That all is a major theme in refining. And you have here this line that is showing you core product demand. Now, we all have an idea about what is product demand. Product demand globally would be around 1 million barrels. Some agencies put it a bit higher. They're more optimistic, maybe at 1.2, 1.3. Our number is a little bit below 1 million barrels a day growth for this year. What you see here is core product demand growth. And the reason why we are pointing that out is simply because there's a huge difference. This is where the refinery products come in. Yeah? And a lot of demand growth nowadays is for what comes in form of ethane. Yeah? And LPG, so stuff that is not necessarily coming from the refineries. So core refined product demand is looking very lousy indeed. So less demand for core products. Yeah? So this is one of the key drivers. On this graphic, you can see another major issue. You can see in the background the total liquids balances. Yeah? Supply minus demand. Total liquids balances are long, as you can see. Yeah? So there is more supply than demand in theory. But what you also see is in green, pointing down the bars. And the bars are showing you that the market is fairly tight. Yeah? And that is the crude oil market. Yeah? So crude oil markets are looking tight. I would say very constructive, at least till the summer, before the whole thing is going to probably normalize a little bit when it comes into autumn. Yeah? More details to follow in the presentation. And then looking on the products, yeah? Products demand growth. We have this kind of graphics that really like to challenge, and I love this graphic because it's telling so much. It's not telling you what is the demand growth, because that would be too simple for you. But what we're telling you is what is the change in our expectation to demand growth. And in order to make this a bit more entertaining, we're going back here more or less till January 2018. And so when we made this assessment for the year 2019, in December 2017, afterwards, every month, we make a change to what we thought the year 2019 is going to look like. And, you could say till about the middle of last year, there was not a big deal of a, surprise. But what you can see is that from August onwards of last year, expectations for 2019 got sour. And you can see both graphics show you the same line. Yeah? So this is the change to the demand growth. Here you can see the changes reflective in the regions. Yeah? Where is this happening? You can see less demand growth expected compared to what it was in Asia and the Middle East in particular. You see here, again, demand growth expected lower. You see that red one? Gas oil demand growth expected to be less. Gas oil demand growth, right? Everyone says, like, that must be a misunderstanding, right? Gas oil demand growth, it's the only thing that is really strong. Yeah, it's strong, but not because of demand. It's strong because of less of supply. So it's always important to watch that out. You see here demand revisions lower for naphtha, gasoline, a little bit jet fuel, fuel oil in particular. Relatively constant up here, yeah? LPG and others, which is basically ethane. Yeah? So the market has taken quite a negative outlook, let's say. Yeah? And when you look on the economic indicators, and we will talk about that, it's looking bad. Yeah? Everyone is looking on what says Trump, you know? Trump and the trade talks between China and the US. A little bit overrated, yeah? Because all the indicators globally are not looking good. So even if the guys make a Kim exercise, it's not going to change too much on the global economic development. Yeah? So market doesn't look great. But what looks great is refinery capacity additions. 2 million barrels this year, 2019. Yeah? Of course, we need only, what, 500,000, maybe 600,000 of core refined products. But let's welcome new refining capacity. You can see here, obviously, China with Hengli. We see here Rapid Refinery. We see Jizan, which is a bit delayed, I guess. Soccer is here. Welcome. So we have a lot of real projects that are feeding into this year. And of course, the whole list tells you there is more to come next year as well. So all that has an impact on how the market may feel about refining margins. Now, IMO. This graphic is telling stories. You see this blue area? That's this blue area. First of all, this is in dollars per barrel. This is in dollars per ton. And you can see that in 2020, there will be a difference between very low sulfur fuel oil and high sulfur fuel oil, yeah, which is going to be quite nice. But we expect that not to be there for so long. That has huge implications. We will talk more about that in detail. Has huge implications. But the lightening crude oil feed that we are seeing, the refining investment that has come forward a little bit more, with all the coking capacities and hydrocracking capacities and you name it, the easing demand is all helping in the same direction. And so probably the market is not going to have a big deal of a problem. We feel confirmed in our 2017 view when we did the study on IMO that basically there is not too much of a surprise. Bunker will remain a fuel oil market by and large. David, ding, 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 anything to add to our key messages?
We will come back to the IMO story later anyway, but what has changed in our view is even more so than before, that the upside to the market from the IMO will be a very short-lived one. Yeah? So it's basically a one-year story, and perhaps it's even something like a 6 or 7 or 8 or 9 month story. But I will explain then also later on in the presentation why we come to this conclusion.
Okay, so then let's jump into the presentation. Yeah? Let's first talk about the fun part of it, which is obviously all related to OPEC and the geopolitics. And let's sum it up with a little bit of a graphic that shows you where is supply coming and where is it going. And first of all, what you can see here, this here is U.S. light crude oil supply expected this year. This is natural gas liquids. This is supply from other producing areas that may be there. And then, obviously, that's used up for demand growth, right? You see we're a little bit below 1 million barrel right now, but it doesn't really matter whether it's 1 million or 900. So, and then you have here another balancing factor, which is OPEC plus and Iran, obviously. The interesting thing is Iran does all the work, right? I mean, it's like, hey, let's do cuts, right? Iran, you cut, and we increase, yeah? So this is exactly what happens right now, yeah? Of course, whether that's voluntarily or not is a different story. But Iran is cutting in a year-on-year situation about 1 million barrel. You see Russia in particular and Iraq, the ones that are actually increasing production right now. Saudi Arabia is trying hard to balance the market in all its expectation. So the other thing that is very interesting is, the other thing that is very interesting is this here. Yeah? Again, the crude oil and condensate balances. Yeah? So the market is short crude oil. Yeah? So right now, prices going higher from a crude oil point of view, sure. What are you waiting so long, right? I mean, market obviously has a good reason to go higher right now. First of all the geopolitical reasons, supplies being constrained, all that makes sense. Next year, you may say, well, let's have a repeat. We're a little bit more conservative here on expectations for next year's shale supply. But again, all the time these things get revised higher. So I'm not making too much promises to OPEC. Whether they then will have a little bit more room to increase or not depends also whether Venezuela is going to have a stronger show or Iran is going to come back or all these kind of geopolitical things that may be out there. Talking about the two, Venezuela and Iran, you can see that on this side here it's supply, here is exports. You can see the exports from both of them have now reached about 1 million barrel level. Yeah? So that's much lower. What does it mean? It means that going forward, there is some more chance for reductions. I would argue that in springtime, you know, what's the next tweet? You know, is the next tweet waivers goodbye, or let's do another round of waivers, but lower amount? You know, all this is thinkable, difficult to guess. Yeah? But the question is, how much lower will that go? Probably together they have another 1 million barrel to go lower. Yeah? Clearly Venezuela now is struggling. What's the next move there? All that is high uncertainty. Yeah? But most of that move is already digested. Yeah? Still, in the next half a year, bullish momentum, bullish upside potential clearly is there. And then comes, you know, flat price. What drives the flat price? First and foremost, tweeting. Yeah? But when tweeting is on holiday, then it is the stock market. Yeah? Stock market at Christmas collapsing, price moved to $50. Stock market recovering, market moves to $60. So there has been a very strong correlation between that. But we have to be careful not to put too much into the China-US trade talks, in our view, because that may not really have so much to say about oil supply per se. What has come in as a new playing field is the OPEC bill in the US, yeah? Trying to take on OPEC. What it means is that Trump has another leverage on some players within OPEC. Yeah? And so he can ask for something. Like today in the morning, he was tweeting, oil price is too high. Immediately, oil price came down. Yeah? So it is like whatever Mr. Trump says is a reality. We have to accept that. Saudi Arabia and OPEC is doing a great job in balancing the market. Yeah? Just met Mr. Bakindo, good friend of ours in Vienna, for the Kuwaiti National Day party. And, you know, it was great consensus on that. OPEC is at its best right now. Yeah? But how long can this continue? How long can you see other countries disappear and do most of the job? Yeah? While when the price is too high, you're, of course, inviting production increases from the US. So we will see more of that. Now, within OPEC and OPEC Plus, you have some key developments. First of all, Russia and Saudi Arabia are engaged right now. They will marry, yeah? Probably in springtime. That's what the current status is. Iran doesn't like it. They're jealous. Because they feel that if these guys get closer and team up, there is a theoretical idea of, you know, what do we need OPEC for, right? We just do it together. But that's the background talk that I can say sums it up. Probably that still is going to work out. They're going to cooperate and want to be very constructive. Of course, it does not tell the full truth. The Russians want to have a moderate price. Remember what Putin said at the Economic Forum in St. Petersburg last year in May. He said $60 is a fair price. Higher price is damaging demand. It's no good. Yeah? And we know Saudi Arabia probably wants to have a bit of a higher price as a matter of income. Yeah? And that is a problem between the two. So Russia will be relatively slow implementing the cuts that they're doing right now. So they're cutting, but they're cutting slow. And Saudi Arabia would eventually be a bit more proactive in getting the cuts done. Iran. Base case strategy, or sorry, base case assumption in our shop is containment strategy. Yeah? Don't allow them to sell too much oil, because if they can't sell so much oil, they don't have so much money. If they don't have so much money, they cannot screw up around the world. Now, that sounds all logical, but is it really containment or is it regime change? If you look on the setup between Trump and his people that are working for him, it's the same people that were in charge, many of them were in charge, with Bush, when he basically made up the story for Iraq and to go after Iraq. And we know that Israel is very supportive of Trump, and right now Saudi Arabia, of course, is also very supportive. So there is, in theory, the possibility this goes for regime change. And you will tell very soon. The propaganda machinery has started in Warsaw, in Poland, at the conference about a week ago, where they said, well, we have to prevent another Holocaust. How can you say something against that, right? It's obvious, Nobody wants to have another Holocaust, right? And the next question is going to be, will there be a prolongation of waivers? I hear from OPEC, well, we have to be prepared for 0 Iranian barrels. But, being prepared for 0 barrels means, what is Iran going to do? Say, well, thank you very much. Right now, we assume Iran wants to sit out Trump. Yeah? Because you hear they're relatively silent. But can they really do that if he goes for a 0 barrel situation, or will we have a proxy for war? So this is the big uncertainty, and we can all watch the news. But it will be happening in the next 12 months that we have an answer on that. The cuts right now are for the first half. Current status is the cuts will be prolonged. I say current status, because then comes tweet, and we don't know what that means. Last year, when Mr. Trump started tweeting, they were very quick in order to get out of it.
You might note that there was a tweet actually there.
Oh, you added it already? How
Yes.
did you do that? Okay, so you were faster. Actually, we're pretty much as fast as Trump anyways, so I didn't see the tweet there. So Saudi Arabia is very proactive managing the market, a tremendous success story. Yeah? 9.8 million now announced for March, which basically tells you they're quite serious. Of course, in March, that coincides with more refinery maintenance. That is not sounding stupid at all. So the market is going to stay constructive. What I see here, basically driven by global economic, global uncertainties and reduction of supply and all that stuff. China is kind of interesting one. China is buying up the market from time to time. Putting oil into storage. Usually they take oil when there is a surplus. They have done that very successfully. But they also were buying into the market when prices were going up, right, David? So it is what we make out of China.
Yeah, I think it's important to note, in general, we talked about all these oil market influencing factors, and generally probably these 4 countries mentioned before will guide the balance over the next year. But China is also a huge balancing factor. Yeah? If you see here that they have been buying late last year something like 1.7, 1.8 million barrels per day more than what was needed. Basically, the additional supply some OPEC countries produced ahead of their cutting deal, then that has a huge balancing factor. The other big question will go on from the US-Chinese trade war situation is basically whether China will resume on a larger scale the buying of US crude. That will be an essential factor, simply because we will point out through the presentation that the refining industry, the oil market, is in a real, what is the contrast to an equilibrium? It's in a non-equilibrium state due to too much light sweet crude being available and a huge lack of medium and heavy sour crude being there. And if China does not help to balance that, and that is basically buy US light crude, take it out of the market, process it also in China, the biggest refining center outside the US, second in the world, then this task remains to a much smaller market, which is to quite some extent Europe. And we do see more and more indications that the refining system may simply struggle to digest the marginal crude slate, which is a very light one, and China's help will be very crucial. For me, that's the key factor about the US-China trade war, whether they solve that and that allows China to buy US crude. Yeah, that's the most important aspect for me for the oil market.
And more of that to come, David, more of that to come, because when you look on this graphic here, we're now talking about other supply and we're talking about US shale. And guess what? The biggest surprise is it's underestimated. It's like, really? What did we miss? You know, it's like 10 years ago, I guess even I underestimated shale oil, right? But we didn't estimate it for the last couple of years, right? So it is something that we have an interesting development. This graphic here shows you a little bit shale output growing. You see in the background in light blue, the natural gas liquids growing. So that's really the big driver. It's still the biggest game changer in the market. Yeah? When you look on the lines here, you see this darker line here, and you see this increase here. This is about $10. This price is not WTI. This is the price what the shale guys actually make out of their business. We factor in local prices that they are getting. We're factoring in hedging activities. We're factoring in a lot of stuff. But basically, we're trying to come up is what is it that they make? And what you can see is the market was jumping here, $10, and the response was 4 million barrel. Now, not in 1 year, but in 2 years. Now, 4 million barrel. And that makes you think, right? Because if prices are not moderated, and if OPEC is pushing prices too high for whatever reason, you know, they are triggering a big wave of response. And right now, this is what happens. We have this response, and this keep on going. Now, from the middle of last year till a few months back, there was this overwhelming theme of the market is having this constraint in the US. And again, nobody was surprised because they always have bottlenecks. They always have somewhere, you know, transportation bottlenecks. You know, we're now here, okay? We have this coming. This is, you know, you take it together, crude oil and natural gas liquids, we talk about 5 million barrels of transportation capacity, debottlenecking the US. It means like the party just starts. Yeah? So I would say in our assumption, it means that probably second half this year, we will have a bit of a bigger supply situation, which you then will see in our price outlook. My screen doesn't work here. Coming to this graphic here, you can see our forecasts. This is the dark blue line. And we also contrast to that the US EIA. I couldn't believe it when I saw the graphic. The EIA is above our forecast, and I was told, well, they just changed their forecast. So they moved up 300,000 barrels and overtook our forecast, which is great. But you can see the lines here, yeah, the dotted lines moving higher and higher, telling us nothing else, but the revisions are constantly being made, and it's moving higher. Yeah? And you can see here, in a 20-month period, the revisions were made for the same period by 2.6 million barrel. Here, 1.6 million, that's still 9 months ago. I mean, who knows where this is going to be in a few months. So here we started just after 1 month already, a revision of 300,000 barrels. So right now, don't underestimate the US shale oil. I say this is like, why would I, you know? But everyone does. And so that's something that, you know, keeps the pressure, yeah, on the light ends. We are very cautious in our outlook here. As you can see, this graphic shows you that, you know, we had this last year, 2.5 million barrel, right? We say this year it's going to come around 1.8 million, with 1.5 of crude, and then you have here natural gas liquids of another few 100,000. And yeah, we're still optimistic down the line. Probably all that line is going to be revised higher. But even if not, you know, the total liquids balance is huge long. Meaning that even if you take a conservative outlook on shale, which is clearly here very, very conservative, the market is flush with oil for the years to come. So you want to make me, be very bullish from the fundamentals. I say, sorry, misunderstanding. I'm bullish because, we have tweeting and we have political considerations and supply constraints. But purely from the fundamentals right now, this is a different ballgame. Yes, there's someone else as well other than the US, and we should never underestimate that. What we see in this graphic is a little bit of a glimpse of hope for those who said, well, there's only US light crude oil. So what you have here is a buildup of capacity additions of about 3 million barrels. We all know capacity addition doesn't mean supply addition, because capacity means you bring a platform on stream, and depending whether you manage to bring the platform up to 100% or not, makes a huge difference. We have seen that in Brazil. Last year, 700,000 barrels. This year, another 700,000 barrels of capacity coming online. The growth rates we have seen there was maybe 100,000. It didn't really come through last year so much. This year, we are now maybe around 200,000. But think about it. 1.4 million barrels of capacity addition and only 200,000 barrels of actual output means there's a lot of supply potential there, which eventually will be unlocked. So we have to be mindful of that. Here, you have the Halfaya Phase 3, the West Qurna Phase 2 in Iraq. A lot of capacity coming. We would expect Iraq not to comply with their OPEC targets, simply because they have a lot of supply right now that is finding the way out of the market. So eventually that is going to be nice because it's the right quality of oil. Also, the barrels coming out of Brazil, once they come out of Brazil, right? 24 to 30 degree, wonderful news, right? Please let it come, We have obviously here, different areas with other supplies, but those are the key makers. What else? Scenario, David. We want to do a scenario. Please entertain us.
Yes. So basically, we do have a setting where I think in the short term there is actually a very good chance that prices can go significantly higher, and that is to quite some extent driven by perceptions, by geopolitical factors, by the current rally we already have type of in the stock market, where there is the economic concerns are pushed back basically, and optimism on the Chinese-US deal and so on is coming forward. That's part of the story. But there is also a fundamental part of the story, and that is specifically on the crude and condensate side, as mentioned before. Now, the one thing I would assume as a starting point of that scenario is that, in difference to our view we have shown you before, Venezuela and Iran may both be limited to 500,000 barrels per day of exports as of April this year. For Venezuela, this could pretty easily be the case just on the basis of the sanctions the US has already implemented. For Iran, it would need a cutback of the waivers, but as discussed before, this is definitely something that's possible as well. So if we lose this close to 1 million barrels per day of supply as of April from those two countries, the balance for crude and condensate specifically turns about 1.5 million barrels per day short in our data for the period from March to June this year. And that, of course, would be a substantial boost to prices. If we move forward one slide, please, for a moment. So what we have on this chart is simply our dated Brent price. In the black line, our base case outlook, which is more or less a straight line. That is, I say the base case assumption, but based on the current dynamics we already have in the market, plus the assumption that Venezuelan and Iranian exports will be limited to 500,000 barrels per day, we can have quite some upside. The ball would then be in OPEC's court. We already have seen the tweet from Trump from earlier today. So what we would assume is going into this April meeting, and we have heard a little bit that there is already some understanding in the background that they will not take a new decision in April. They will just roll over the cuts, basically. In line with that, what I would assume to happen is that, as OPEC has done very successfully over the recent years, basically talk the market in the direction they want to have it. What would that mean is that basically they may come out over the next month 2 months with some statements, we will take care, we will supply a little bit more, and that might take the heat out ahead of the April meeting. If it happens that way, basically we would simply have a situation where the constructive or the fundamental picture in the short term is definitely pretty constructive. I mentioned the other factors around that, and then we could have something like overall a 4-month price rally, not so different from what we had in the second half of last year, but that would, of course, trigger various responses. So the one would be that then latest by June, OPEC would most likely basically be more or less forced to stop its supply management, and that we would assume in this scenario to happen as of August next year. And the other thing, unless if you can quickly move back. One slide.
Right.
So the one thing is in the green bars that we assume the OPEC cut to be ended as of the second half or August specifically 2019. And the other thing is that, of course, another 4 months of 70 plus oil prices will give another big wave of support to the US shale industry. Remember that hedging tools can be used to lock in prices, so such a rally would in all likelihood be used by the shale industry to hedge their production the rest of the year, next year, and in such a situation we would simply expect a significantly stronger wave of US shale. We already do in the base case. By the end of 2020, that would be in that scenario assumption here some 2 million barrels per day additionally. Remember the chart before on the pipeline constructions. I would like to add one comment of that. We have this 5 million barrels per day of additional pipelines for crude and natural gas liquids only out of the Permian. All these are finalized projects. There is an investment decision taken, and usually you can assume that there is that the volumes have been booked. Yeah, not perhaps to full extent, but at least to something like 50% of would volumes be expected to book. So that is a clear warning signal that there is potential for much more. And of course, if we get to that, then and we've assumed that OPEC does not cut again next year, of course this is a possibility. But if we don't assume it, we have here a surplus of total liquids of close to 3 million barrels per day next year, and also the crude and condensate picture is strongly in the long side. And if we move back then to the price chart, that would of course herald a suggestion that prices would fall quite substantially. What could come on top of that is then that the IMO effect that is generally still assumed to support potentially also outward prices to a certain extent. If it then turns out that this is not really giving a consistent support to the industry, specifically also to the refining industry, then you can expect run cuts, and then all this feeds through to the crude side even stronger. So we see basically the recipes in for quite some volatility in terms of oil prices going forward, with the risk in the short term clearly to the upside, but the risk for next year to the downside. Yeah? So in a nutshell, basically the question will be whether this OPEC excess to cut back production again and again in a type of response to US shale industry is something that can be successful in the long term, or whether it may fail at some point of time in the not too distant future.
Very good. I mean, this may lead to a Naimi kind of effect, right? Remember, Naimi said, you know, he's not going to cut because he did this he remembers when that happened in the 80s. He's not going to do the same thing, and that he cuts and everyone else is increasing. I think the current players said, well, we can do that together. Russia and everyone else, we can do that. But of course, the price signals that some players are giving are too bullish, yeah? And that is not without controversy. There are a lot of guys within OPEC that don't like that. Yeah? They want to have more moderate prices. So that may lead eventually to a disintegration of the organization down the line. Let's talk a little bit about demand. I start a bit, and David maybe does a bit more work down the line. But let me start here with this graphic that shows you oil demand, yeah, change, and you see all these beautiful colors that tell you which products are the ones that are pushing. I think what you can see is that when oil prices moved down in 2014, we had this very strong increase in blue, which is gasoline. Flat price was low, gasoline was benefiting. When oil prices moved higher, gasoline demand literally disappeared. Last year, we had very little oil demand growth from gasoline. Only in the end of the year, we saw some of that coming back, in China in particular. We have seen in this period of time here very little gas oil demand growth in 2016, and then it was coming out of the blue in the year 2017, really very strong gas oil demand growth. Starting second quarter last year, that was on holiday. Yeah? It came back partly in some countries, particularly at the end of the year. We will talk about why and where. What you also can see is very strong reduction in fuel oil demand. Huge reduction in fuel oil demand. Hello, fuel oil demand going down. It's not strong because demand is strong. Demand is weak. Yeah. So amazing. Yeah. It's incredible. And again, gas oil is not strong because gas oil demand is strong. Yeah. Gas oil is strong because of supply. So gasoline demand, guess what? It's improving. It's now improving because prices have been relatively moderate. So we would expect this year gasoline actually to perform relatively good. The strongest product, however, is others. Ethane. Yeah? Was pretty good last year, number one position last year. This year, again, number one. Yeah? We talk about numbers of about 250,000 barrels a day. This year, last year, it was around 300,000 barrels a day demand grows, purely from that segment. Yeah? LPG, benefiting great deal, yeah, from the same segment. To make it more clear, this graphic showing you in light blue the LPG and others, yeah? And in dark you see the core products. And you can see very nicely how big actually the demand is for ethane and LPG. Now, it is something where like chicken and egg, right, kind of thing, you know? What comes first? In the US, you first need to have a petrochemical facility that can consume ethane, otherwise there's no ethane demand. And if there's no ethane demand, you don't supply ethane. So you have this kind of fruitful relationship last year and this year. And so you will see continuation this year with a lot of ethane demand triggering supply. And of course, all the shale gas has helped tremendously in supplying natural gas liquids. And so all that is hitting the market. Right? This graphic is beautiful. David, to challenge you a little bit and to enforce our interactive style of presentation, why is this line red and why is it so high?
Yeah, what we see here is simply the contribution of the US alone in the dark blue bars to world demand growth. And what you can see there is that, more or less speaking, over the last 6 months, US was basically made up 100% of world oil demand growth. So it's also on the demand side of picture, basically the shale industry somehow is flourishing. And there have been two main components to this blue big area. That's on the one hand diesel, and diesel is a fuel that is related to the expansion of the industry and of the economy, also partly more or less directly to the shale industry. And the other thing is mentioned is US ethane production. Going forward, we expect only the ethane element to really remain strong. We do think that there is by now also quite some indicators on the yellow side on this chart that suggest that diesel consumption should go down. Slowing manufacturing index, slowing freight index, and in heating degree days, I mean, the picture has been mixed, but in large parts of the winter it has been pretty warm. So we do think that the diesel demand rally we have seen in the US last year will basically fizzle out over the course of this year. Just one other example, basically, of how things are slowing down is OECD Asia. You can see on this chart that the last couple of months have come in very slow, decline of something like 400,000 barrels per day year-on-year in the decline, driven primarily by Japan. There is the warmer winter that comes in there and the kerosene bars, but it's pretty much consistently across the board. Yeah? So there are, on the oil demand side, very clear signs that the global economy, or at least parts of it, are significantly slowing down already. And the next example is, of course, our nice continent, Europe. So you can see here there is a significant reduction in the consumption pattern happening this year. It comes, and I think this is an important ingredient, it comes after 3 very strong years. Yeah? So a part of this slowdown is simply a function of the extremely strong demand we have seen on a consistent level throughout Europe in the years before. But of course, it also comes on a slowdown of economic pattern, particularly countries like Germany are clearly suffering. There is a little bit of an outage aspect to it, with the Rhine water levels having been so low and some petchem and refining plants needed to go out of operation, but that is really only a minor part. What we can also see is that the red bars, the diesel declines, is very big. The gasoline increase is there, but it's very marginal. So what is not happening in the bigger picture is that diesel cars are replaced with gasoline cars, and that is a type of one-to-one substitution on the demand side. That's not the case. Yeah? It's only a marginal factor. And then finally, the interesting aspect you might see there is as well the naphtha picture. European naphtha demand was declining throughout last year. And we see this again on this chart here. This chart shows you petchem feedstock demand on an annual basis and on a ton basis, which is generally the better means of comparison here. From an outright point of view, what you can see, 2018, so basically stable petchem feedstock demand globally according to our data. It's the yellow dot on the left side. And that, again, is a clear-cut warning signal. Naphtha, or the petchem feedstocks in a broader way, are typically an early indicator of the economic cycle. Now, what this chart tells us furthermore is that there is a clear substitution going on. Region-wise, North America has pretty much been the only region growing last year, and that is the ethane story. The markets that have lost out, it's primarily Europe, but also other markets, rest of the world. And looking at our forecast, we can see that the North America component, the ethane component, is continuing to seem to be strong. There is a lot of new capacity coming in. What I would question, however, potentially about our own forecast here is the level. Yeah? So you can see we have a pretty solid overall forecast for petchem feedstocks over the next couple of years. Will this really materialize? Let's see. Yeah? So if the economic slowdown does happen to a stronger extent, then our outlook will look more like the actual 2018 figures, and that means continued declines in naphtha demand, continued reduction in the petchem operations of those players that are naphtha-based, and unfortunately that includes the European players, but also quite some Asian players. Yeah? So there is a clear-cut cutthroat, so to say, competition going on in the petchem industry based on the US shale industry once again.
So currently we have, for instance, an expectation that this year naphtha demand is going to grow by 24,000 barrels. Last year it was down 155,000 barrels, right? What David basically says is if this continues, right, like all this naphtha and also the LPG, and if it goes more in the US and, something has to give, right? So it will show another few, maybe blue or other colored bars going down, but it's probably naphtha that will have to give, right? So that is what we may expect here. And fuel oil, David?
Yeah, finally that fits the picture simply as well. So we have recently, in our data, 2 observations in a row of a 500,000 barrels per day decline in global fuel oil demand. This is 7% of the demand base. That is partly power generation driven. Also there, high prices may play a certain role, but there is often a general substitution policy going on. But also bunker fuel indicators, from bunkering hubs came in slower recently. And that is also something that leads us basically right into the refining trends that we see going forward. It is really remarkable that a product that loses at least recently 7% of its demand is actually the leading product, at least at the margin in the refining industry. And if we look at this chart, there you can see what we're doing is we're taking type of global product cracks and we look how these product cracks have performed versus the 5-year average basis. And what you can see is the star performer on this chart is actually not diesel, it's fuel oil. Yeah, fuel oil is really the product that is pricing out of its historical range. Diesel and jet are doing okay. Yeah, they're more or less at the 5-year average. The products that are losing out is also very clearly here. It's naphtha and LPG and gasoline. Sorry, the light end side of the market.
Looking on the natural gas liquids, now it's a $1 per barrel graphic, not to confuse you too much, but you have seen this huge supply growth, right? We have seen here this very strong volatility on the frac spread. That was because the natural gas prices in the US last year had suddenly spiked. Yeah? Of course, then it's not so economical to extract natural gas liquids. So that was leading to a lower frac spread. Now natural gas prices have eased, they have come down, so we're expecting the frac spread again to go higher. And you can see here, expectations still for very robust ethane and propane supply growth. The next graphic is telling you the refiners' kind of challenge. You see here the last couple of years. You can see the year 2016, 17, 18, and 19. You see the marginal product that comes out of the global refining system, right?
Crude distillation unit. That's
of crude oil distillation units, right.
So it's built out of our refining model we employ on a monthly basis, and it tells you what is basically the incremental supply of crude oil that comes into the market, what characteristics does this crude oil have, and what happens if you send the incremental supply of crude oil through a distillation unit. And what you can see...
Yeah. First, before I allow you to entertain us on the graphic, you see here, just to read the graphic, you see the change in the annual API. Yeah? That's what does when you take the feedstock in that comes new into the market, and what does it do on the global API, right? So you see here a lightening of the crude oil, yeah, that is going on now for 3 years, and we see that something is missing, David, right?
Yeah. What you can see last year already, and we expect this year again, is that if you put this marginal crude oil into a crude distillation unit, you get basically pretty much entirely naphtha, a little bit of kerosene, and that's largely it. Yeah? Only tiny portions of a gas oil and the heavy gas oil component, but no residue. Why is this important? Because the residue is what you can work with. If we look back to 2016, basically the marginal crude slate got much heavier, so the marginal crude slate basically exclusively gave you residue, and that means in the global refining system, out of this residue you can make whatever you want. You can make diesel out of it if you rather push it towards the European market, European type of setups. You can make gasoline out of it if you run this marginal crude slate in the US, or you can also keep it as fuel oil if it were of interest. Yeah? Usually it's not. At this point of time it actually would be. But at this point of time there is no marginal feedstock that gives you fuel oil. And that's very important, basically, the underlying component that we have currently at operation in the refining industry.
Especially as we get new refineries coming into the market that are looking for that type of crude oil. Yeah?
Yes. Yeah, now just to illustrate these things a little bit further, what we see on this chart is how world gasoline supply is developing. And perhaps a little bit history again, 2015, huge increase. We had this strong fall in prices, a lot of gasoline demand coming in. And the gasoline demand was met by both additional crude intake, but in particularly also by yield shifts towards gasoline. These yield shifts were then taken back to a certain extent in 2017, but last year, and we also see this for this year, basically the gasoline supply is growing again. It is growing primarily out of a crude intake perspective, so new refineries basically processing the marginal shale crude are type of forced to produce gasoline. On the yield picture we see it more or less stable. Sometimes there's a little bit of upside. You may ask why, who would produce more gasoline in this market where gasoline cracks are so weak? Part of the explanation is China. Let's if we look at the next chart. We see here in the blue line, right chart, Chinese gasoline yield. It's a relatively big scale, but you can see Chinese gasoline yield is going up. That is related, for example, to 400,000 barrels per day of gasoline-making units that were installed last year in Chinese refineries. Yeah? This year, I think it's another 300,000 barrels per day. So if you look back at the last 5-year history of Chinese demand growth, it's a lot of additional gasoline, essentially zero diesel. Yeah? So Chinese refiners do have an incentive to produce more gasoline, and in particular petchem feedstock. What we can see here is that they have a huge loss in the diesel yield. Partly there are reporting issues at hand. It's a question of how light cycle oil imports are, for example, accounted in the picture, but it's also simply a fact that the Chinese crude slate is also getting lighter, and the refining setups are basically also domestically incentivized to produce less diesel. The other market that in theory could produce more diesel going forward is the US on the left-hand side. However, we do have here in particular the story that the crude slate gets lighter and lighter, and a couple of players like Valero and Marathon have in the recent earnings calls said that they are already fully maxed out diesel. They cannot produce more diesel. So even so the market would, in terms of margins, call for more diesel, it's not straightforward to see where this more diesel would come from and the less gasoline would come from.
And the crude oil is also not there, right?
Yes.
We see less coming in, and the crude oil that would be there is getting so expensive. So we will show you a graphic about the pricing of that crude oil that makes it clear why it's not very economical. And you're looking on the product stocks, you can see here a scenario, because that's assuming now whatever we see here to play out in the next couple of months. And it's not very comforting, because you can see that we have here a very, very strong increase, continuation, right, of what we have seen last year, strong continuation of increase in light distillate inventories. Of course, that will have an impact. It will eventually trigger refiners to do cuts or other stuff, and that eventually will help. Yeah, so it may not be like that, but this is what you should expect right now. And that's bad news, right? Of course, middle distillate is a different story. That's pretty much of an average kind of thing.
Yeah, the bad news depends a little bit on which player you're looking at. If we look at the next chart, we can see that there is a huge narrowing of the margin difference between complex setups and simple setups. So you can see, especially in the US Gulf Coast, our data recently suggests that a complex setup made $1 per barrel more than a simple setup. That's indifferent to values typically in the double-digit area. And that's a reflection of all the product spread developments and also the crude price availability. We'll show more details on that.
What it also, before I move forward, what it also shows you is there is a new swing, a potential new swing refiner. Remember, historically, when we speak about swing refiners, we would have meant Europe, right? Right now, you have green and red, yeah, and so that means we would talk about US Gulf Coast and Singapore, and that's completely new. Yeah, it's opening up a new kind of perspective. Looking on where does the refining system take in more crude oil and what type of crude oil, we're looking here on the US. And what you can see is the API gravity changing. You look here on PAD 3, on the PAD 3 areas, and you can see up here the dots. That means API, yeah? So they're taking 4-degree API higher crude oil into their system right now than what they would have done. How much long do we talk?
2013.
2013, right? So that's amazing. Yeah, that's amazing. So you can see a lot has already been done by the refining system to accommodate for that lighter crude, and it's obviously getting more and more difficult. And this difficulty we're trying to show on the next graphic. What it means here is that what will happen now as 500,000 barrels of Venezuelan crude oil doesn't come into the US. We know that Maya has a fuel oil link in their formula. We know fuel oil is very expensive, so that is expensive. Saudi Arabia and I think also Iraq have increased their OSPs for their crude oils, which makes it not so easy for the US system to take more. And so the question is, how much more, David, can we take in light crude oil? Is it not possible for them just to take the cheapest, which is light?
Yeah, it looks like that we might now really be coming into the technical limitations of adding additional light crude. In the chart before, we saw 4 API more on average in certain US Gulf Coast setups. You can imagine distillation tower that has the different exit points for LPG, for naphtha, for light and heavy gases, and so on. And these exit points have a certain capacity. Now, if you replace a Marine type of crude oil with a WTI type of crude oil, it has a naphtha cut that is 3 times higher. And you will therefore, if you replace this on a one-on-one basis, not be able to take the same volume of WTI crude into the same refinery that went before a Marine crude. Yeah? Now, normally, I would tend to say at the margin the system can always cope, but as we have now years after years in the same direction and systems already stretched out probably to the limit and runs having been very high anyway, we do feel that this need now of the US to replace 500,000 barrels per day of Venezuelan crude, and that will only hit from here onwards because until now cargoes have still been arriving, may really place a technical limitation on the level of crude intake in the US.
So basically you would lose here, if you look on the difference between a Marine crude oil and quantity, and you can see you can only take so much TI. Yeah? You're losing here a certain amount of volume in the market. Now, we would have argued anyway there is this year going to be lower runs in the US. Right now it's not difficult to predict that because it's maintenance season, so they are lower. Yeah? But there are good chances this may continue a little bit more down the line. And when you look on the refining incentives, right, you would say, well, obviously everyone wants to have medium sour crude oil, so medium sour crude oil must be really good for the refinery, so the incentive for a refiner to run medium sour crude oil must be fantastic, right? Yes, well, our refinery incentive graphic, yeah, where we are blending in certain crude oils and compare it economic-wise, are telling you here that whether you take Arab Medium, whether you take Maya, whether you take Basra Heavy, Arab Light, they're all giving you a worse outcome right now than if you were running WTI. And the reason being is simply too expensive. Yeah? They're pricing it so high, or fuel oil is so high so that the formula makes it so high. At the end of the day, it's pricing out of the market. Yeah? So that leads to a very unfortunate situation, David.
Yeah, it's again basically what we're showing here is a comparison of coking margins specifically with simple setups. The first thing you can see is that the bolder lines are coming down to the same level as the thinner lines from the simple setups. There is also an interesting detail to the crude quality again. What we have recently is that WTI margins also on the coking side are simply better than Mars margins. And it at least temporarily would have been even preferential, according to this margin calculation, to put Mars into a simple setup rather than a coking setup. Yeah? So that's exactly where we are. What I said before, that at the margin, sometimes in this world we're right now, it can very well make sense to keep fuel oil out of the conversion unit and sell it to the market directly. And as we go into the IMO development next year, this will of course be a viable option. But the market tells us already now that these economic incentives are there. It's always a question of economic incentives, what you're doing.
So what we would see is that eventually down the line, we have here more green bars, which are telling us run cuts at existing units. There is constantly new capacity coming in, and you also have some contribution from maintenance. Yeah? So run cuts eventually down the line. And coming to the last graphic on refining trends, you can also see on this graphic here, on the left it's capacity additions, on the right side it's the crude oil intake change. There are several things we see. First of all, the run cuts we would suspect will partly come and will be contributed from the US.
Yeah, that sounds to be a very bold call. Perhaps it's also a little bit on the strong side. But as said, we are in this situation, and there is little that tells us that this situation should change significantly this year, that conversion economics are really under pressure, in particular in combination with gasoline. Yeah? So a coking FCC setup currently is really under pressure. And then you have also to take into consideration that the US is not equal all around its territory. There is, for example, the East Coast, which is currently massive under pressure. There is this strange situation that crude shipments from the US Gulf Coast with shale oil by ship to the East Coast have to go on so-called Jones Act, domestically produced and operated vessels. And that means that US shale crude on a delivered basis is basically cheaper in Europe than on the US East Coast. Yeah? So this is just one. It's not a particularly big refining segment of the US, but that is definitely under pressure, and other elements are under pressure as well. So we come to the conclusion the US refinery runs are likely to be lower this year than last year. Apart from that, we can also see that over the last couple of months, the red bars on the right-hand charts have basically been nearly inexistent. That is pretty striking. So Asia as a whole has seen no growth or barely any growth in crude intake for a couple of months, in spite of all this new capacity coming in. And this is also a clear indicator that, of course, economics play a role there as well. And one factor that has always been there, but I think it's particularly important in this point of time, is that Asian or crude oil for Asians is basically always more expensive than for the rest of the world, because all the crude that goes to Asia, or the huge majority of it, has gone a very long distance and accordingly has associated logistical costs with it. And that means that on a crude procurement cost basis, for example, Asians are positioned poorer than the European refining industry, which also benefits from the situation that diesel cracks are leading the margin, and with primarily diesel-based setups operating in Europe, that is sheltering the European refining industry to a certain extent.
All right, so the conclusion is that you don't want to be an Asian and US refiner right now. So IMO update. I guess most of you know we have done a study on that in 2017. At the beginning of 2017, the basic view was it's going to be a fuel oil solution. Yeah? Very low sulfur fuel oil. And of course, you have a text slide, David. I hate text slides. So
yes, I know.
You really want to do that?
But, no, it's just very quickly to sum up things. it's a too long story to tell it now, yeah, the whole IMO story. That's very quickly, yeah. So we expect next year the fuel oil of choice to be a very low sulfur fuel oil, about 2.3 million barrels per day. We see about 1 million barrels per day of high sulfur fuel oil that is largely fuel oil being used on ships with scrubbers. To a minor extent, it's non-compliance. And we see only a pretty tiny upside to marine gas oil, to a diesel middle distillate type of solution that in our view will only temporarily at the beginning of next year be a fuel of choice here and there, but we are feeling more firm than ever. Then basically very quickly the fuel oil will take over again, or will stay simply. The low sulfur fuel oil will be the bunker fuel of choice. We think that compliance will be very high, except for early on. The global level of the specification plays a key role, and the role of bunkering companies will also be important there. And very quickly on the scrubber side, we expect 2,000, a little bit more than 2,000 ships running on scrubbers early next year. Generally, this development has been a little bit faster than we expected originally. The exit figure next year we expect to be about 2,700 ships. The number of ships, by the way, is not necessarily the most important thing. The question is which ships are operating scrubbers. It's the big ships that are important, but we understand that there is quite a number of VLCCs and other big ships that is going the scrubber direction. As already indicated earlier on, the viability of scrubbers will be a very short-lived one.
So where's this very low sulfur fuel oil going to come from, David?
Yeah, it's ultimately pretty easy. There are various choices. The first thing that's very important, that is fuel oil segregation. In the past, most refiners around the world had no incentive to separate fuel oil streams by sulfur level. Why? Because there is often no low sulfur fuel oil market. So you put everything together, and we understand probably the sulfur level of high sulfur fuel oil this year is just something, I would guess, 2.3% or so. Yeah? So it's by far not the 3.5% it could be. So that means you can separate streams out in an optimized way easily, and already by that you get part of your solution. Of course, it's also possible to desulfurize residues. That's not a big ticket item, but for example, all these big new hydrocrackers in Asia allow to a certain extent also some residue desulfurization. The crude slate that come later on, I mean, there is a certain potential to optimize, so to say, in the short term, which crude oil you take in your specific refinery. On a global level, this is not really the solution. The key solution on the global level is simply to take out those straight-run fuel oil volumes that match the bunker specifications, yeah, that have the right viscosity, but in particular the right sulfur level. There is no question that there is more than enough of such volumes available. Yeah? It has only in the past usually made our clients or other people who listen to us raise the eyebrows that we say, why would you do that? Yeah? Why would you take a valuable secondary feedstock and put it into the bunker fuel market? The point is simply, it's just a question of price. Yeah? If the price for this stuff is right, then you don't put it in a coker, you don't put it in a FCC, you just sell it directly to the market, and I will show that a little bit later on. And middle distillate blending plays a very marginal role in our view.
When I look on the crude oil choice, this graphic many of you may have seen before. It shows you in green those grades that are matching the sulfur limitation. You see the bars, that gives you the atmospheric residual. So if you have a crude oil with a high atmospheric residual, it's great. It gives you a lot of very low sulfur fuel oil in this segment here. And here in red, you see those grades that would not be suitable because they are too sulfurous. Now, there's some interesting development with all this lightening of the crude oil streams. Is the green, arrows pointing up here means there's more of those grades available, and the red ones that are pointing down means less from those. That means, the crude oil that comes into the market helps to resolve, to some degree, the bunker fuel question for next year. And to make it a bit more drastic, I love this graphic. It is really good. It shows you how that has developed in the last year or so. The crude oils that are low sulfur are trending higher, and you see here suddenly the ones with high sulfur atmospheric residual are dropping sharply.
So just to explain the chart a little bit, what it does, it takes the marginal changes to the crude slates, so more US shale crude, less Saudi crude at the margin, less Venezuelan crude, and so on, and calculates the straight-run fuel oil yield from that crude. And what this chart tells us that the crude slate has gotten so much lighter that we have just over the last 2 years 800,000 barrels per day more potential for low sulfur straight run fuel oil, and at the same time 600,000 barrels per day less potential for high sulfur straight run fuel oil. So basically the change in the crude slate as such, without any refiner doing anything, has made solving the IMO challenge by 1.6 million barrels, 1.4 million barrels per day easier than we thought basically 2 years ago. So that's one key element, and there are other factors as well that have changed over the last couple of years that make it easier. One of them is simply that, yes, there has been a lot of new refining capacity coming in. It's still coming in, especially in China. It's coming in faster than we thought, and there is also a lot of conversion units and desulfurization units and so on. So the refining system is way more complex in 2020 than it used to be a couple of years ago, and at the same time, the marginal crude slate it gets is a much more simple one, and that automatically leads to a much easier supply picture for the IMO question.
Excellent. That brings us right away to the prices, right? So we look at these prices now again, you have seen this graphic before. We look at it now in more detail here to just confuse you, but it's not telling you anything different from the next graphic. So you can see here the decline we would expect in high sulfur fuel oil. Again, here barrel and here in ton basis. You can see very low sulfur moving here at a little bit of a premium probably. Here you can see this in dollar per barrel. So the spread, is going to be nice but short.
Yeah. One key feature on the left-hand chart is that the green line is above the blue line, which is gasoline. So if the very low sulfur fuel oil, a barrel of that is valued more than a barrel of gasoline, it is relatively easy to understand that it might not be the best option for a refiner to put that barrel of very low sulfur straight run fuel oil into a coking unit, into an FCC unit to make then gasoline out of it, where at least at the barrel basis it's worth actually less than what you put in at the beginning of the process. Yeah?
Now we did expect that, didn't we?
Yes, we did.
But now the market, with all its lightening, I think now the market is feeling much more comfortable with that.
Yes, and it will not take long to make the adjustments, and therefore the incentive will not be there. The other important thing is that the price of this very low sulfur fuel oil can, without question, go as high as the marine gas oil price in this dotted dark blue line, simply because it's an alternative. Yeah? So basically, why should you provide it cheaper at all? Yeah? You will probably not provide it cheaper at the beginning. Actually, the real choice, both from a refining and from a bunkering side, is the ton chart. Here you can see on the right-hand chart that there actually our bunker, very low sulfur fuel oil remains still significantly cheaper than the marine gas oil. But anyway, you have all those room available up to the MGO price, and that's basically the economic incentive that can be given to find a very low sulfur fuel oil price solution. And that incentive will be used to the extent it's necessary. In difference to what we thought before is we don't think it will be necessary that this incentive is high for a long period of time. Yeah? Because once we go into next year, there will be a surprisingly big amount of this very low sulfur fuel actually being available. And that means that at some point of time it will be more than enough. Yeah? I would guess second quarter, third quarter, something like this. And once it is more than enough, it has to find its new independent pricing equilibrium, which will be significantly lower than the marine gas oil price, and that means that over time nobody will use marine gas oil that is not needed to do so based on specific geographical or local market circumstances. The other thing the story means is that the scrubber installation will be a short fun, so to say. Generally speaking, a lot of people, when looking at the scrubber question, look at the difference between high sulfur fuel oil and marine gas oil, because so many people think that marine gas oil is the alternative. We would say that's right from the beginning the wrong question, but even if you give that for a moment a chance, then we have here a spread temporarily for next year of something like $270 per ton. That would still work to incentivize scrubbers. But if you look 1 year forward, we have actually a spread here which is less than $100 per ton, and with less than $100 per ton, we don't think many more scrubbers will be installed on a new basis. Yeah? So we think the scrubber story will be a short one. Yeah? It's moving relatively fast and basically to its end as well. That means that the market in a bigger extent will then simply remain a very low sulfur fuel in the market.
Good. Now, I'm sure you're fairly fresh. You know, we only had 50 slides. So
let's do an easy chart.
I have one for you where you say, well, you know, this is a typical JBC Energy graphic. It probably takes you a day to recover from that. But it's good, you know, so why not to share it with you? And you can see here the bars. You know, the bars are showing you 2018, 2019. Yeah, so the dark one is 2019. Then we look forward into the future, 2020, 21 to 23, and this red one is here, the 16-18 average, right? So, and I guess what's the story? The story is you look here, compared to last year, much lower margins, right? We're having here margin outlook. The margin is not looking that great for this year. Oops, much lower. Oh yeah, you don't want to be here, right? So, and we're saying basically Singapore simple Dubai-based margin looks sour. Yeah, we don't see a lot of fun, right? Here, and particularly simple margin in Dubai. So why is this the case, David?
Yeah, the key question will be if the price incentives, as said before, or let me start from this way. We do see right now very clearly that the refining industry is in deep desire for medium and heavy crude oils. Now, with our thoughts on the IMO impact and all those factors that ease that impact, it includes also lower demand, more capacity than thought, and a much more supportive crude slate. That means that it's actually not a given that a medium sour or a heavy sour crude oil will have the discount next year that a simple setup or a straight CDU one would suggest. Yeah? There might simply be refiners around the world that have complex operations and that will price up the value of those crudes to a level where it still works for them. So, for example, the US Gulf Coast Moga setup in the middle of the chart. But this price will then not work anymore for a relative simple setup. Yeah? Now, if you look, for example, the Japanese refining industry, it's not necessarily simple, but it's also not particularly complex. But it's nearly fully based on Middle Eastern crude. And especially this Middle Eastern crude could be very expensive next year. And that's then basically those type of setups in the Asian market right to the right of the chart where the real trouble could come, and where also some not necessarily refining shutdowns, but at least one cuts are pretty likely to materialize. One thing I want to point out quickly is the very left of the chart. This is Northwest Europe, and we're not trying to do somebody a favor here or something like this. It's simply the outcome and of all the price forecasts we're doing on a monthly basis. Some of you might have seen out there our view report. So once a month we do a price forecast for all world regions, different products and crude. And the outcome of that at the moment for Europe is actually looking pretty solid. And why is that again? Because we do have a reasonably cheap crude available. The Brent market is pressured by all the US shale crude exports that are reaching the market, primarily in Europe. And the other thing is European margin is simply led by diesel, and the diesel strength we expect to continue for another year, this year and next year. I didn't make the comment before. Next decade in general, we expect things to turn around again. Yeah? So we expect diesel demand globally to disappoint and gasoline demand to come back stronger, and also refiners, after a probably very disappointing driving season this year, will start to really make stronger adjustments to their setups. And therefore, I could imagine that gasoline might be the surprising product to the upside already next year, but definitely then later on in the next decade, we see a comeback, so to say, of the light ends to a certain extent, and that is then turning things here around a little bit at least.
So really interesting to see the US Gulf Coast simple, having a better outlook than the complex. Yeah? So market is interesting. So let us come to the final 4 slides. What does it mean for the crude oil markets? We already gave you our view on how we think that the market is more bullish in the first half of the year and probably more bearish in the second half of the year. So let's talk a bit more substance. What you see here are different crude oils. You can see that the red line is heavy sour crude oil. And you see this line here? That's right now at the 0 line. Yeah? That's what we're benchmarking it against, so basically Brent. And that's amazing, right? So we're having the same prices right now for heavy sour. Now, we're not expecting this to maintain. Yes, we would expect, again, some discounts to come in, but it shows you how crazy the market is. Medium sour crude oil is going to maintain some kind of premium for the limitations of supply right now. That's particularly going to help to stay relatively strong, particularly still in the time as long as those grades are not discounted from the IMO perspective. And, of course, heavy sweet is, looking great. So basically, high-density crude oils are having a certain advantage. Coming to the differentials, looking on the Brent TI, what you see here is the development in the last couple of weeks or months, where this differential was anywhere around $10, moving down to $7 and up again. The blue line is showing you the forward curve. So the forward curve right now, $10, TI lower than Brent or Brent higher than TI, and then normalizing around the $7 or $6.50 range. And you see here the dotted line, which is our JBC Energy view, where you can say, well, we're a bit more relaxed about that. We would say there is, more easing of the bottlenecks, right? In the Permian region, we see that a lot of the capacity additions coming in will reduce some of those bottlenecks that have created the big price discrepancies. And so we would not argue that this is going to stay that long. So more exports eventually and more oil able to move out of the Permian region, and finding an equilibrium somewhere around cost. East of Suez is the area where demand is growing. As we all know, oil in the east of Suez is partly moving to Europe and in the US. This is the blue one. And of course, barrels from the Atlantic Basin are moving into east of Suez. And if you look at it on a net basis, you can see that here a sharp increase now happening of barrels moving from the Atlantic Basin to Asia. So obviously, we would expect with more Brazilian barrels, more of that to happen. We expect, of course, more US barrels. But the first destination of US barrels is Europe, which also helps European margins partly to look nicer. Coming to the last of those beautiful graphics, a Brent-Dubai spread. Right now, Dubai is strong. It's like everything is upside down. Dubai is the strongest, followed by Brent, and TI is the lowest. When I was young, it was exactly the opposite, and so it just tells you everything is relative. Yes, we would expect again that Dubai will be relatively strong, but
it's the dotted line in the forecast. Huh? The dotted line is our forecast.
That's our view. Yeah. This is the forward curve, right? So we would say there is a relative strength in the fuel oil element that's going to support this year. Yes, you will see then in this period of time, from our point of view, a little bit of a slowdown simply because of the IMO story, which will discount obviously Dubai. Before that is then again digested by the market and things will level out. So, conclusion. The market has enough oil, not the right oil. Total liquid supply is ample. Crude oil supply is not ample. Politics go haywire. I would say everything is possible from that point of view. Trump is unpredictable from that. I can say we have to be very, very careful. Everything is possible on the upside. From the pure fundamentals, the market has much more to do in 12 months from now on the downside, much more. If it comes to geopoliticals, the market has unlimited upside potential, but of course the question is then for how long. So that is something where it's not so easy. Natural gas liquids will be a key dominant factor. Simply putting more in, very price competitive, means something has to give, and naphtha doesn't look great from that point of view. So that's this. You want to wrap up on refining, David?
Yeah, the light end overhang will continue for at least this year, probably next year as well. It's simply all these natural gas liquids dependence products pricing itself into the market. Then it is a real burden for the market right now to lose the OPEC supplies on top of all the other supplies. So the strength of the crude quality we discussed in length now, and the fuel oil values reflect that stress that is basically put on the refining system. I mentioned coking and FCC setups are potentially losing. So we would not be surprised to say this also explicitly if the one or other coking FCC setup in the US would even be shut going forward to be more permanently set on a light crude mode. Apart from the quality aspect, there is this separate problem that there is simply too much refining capacity. Remember, 2 million barrels per day this year. I think 1.7 we have for next year, while the core refined product growth is something like 500,000 barrels per day in our data. There is too much capacity, and that means margins overall have to go down. They will go down more if there is no lead product. Right now, we still have diesel as a lead product, but if the IMO disappoints, basically we might be in a market without lead product in the second half of next year, and that could be then a key period of refining margins collapsing and consolidation setting in. The IMO story, as said, will be much shorter than we thought. The prices of medium and heavy sour crude will probably not come as much under pressure as originally thought. There will be definitely some impact on those pricings, but probably not as much and not as long. And it's basically the simple refineries that are operating on this medium sour crudes that are, in our view, are most exposed. And we should keep all the time a look at the oil demand. There are, and just trying to repeat this quickly, we have seen European demand growth declining strongly, OECD Asia disappointing, we see diesel demand disappointing, we see naphtha demand disappointing, we see fuel oil demand disappointing. All those elements do suggest that the global economy is really slowing down, and oil demand is often an early indicator where it gets visible first. Yeah? So this is something we have to keep an eye on. And of course, the type of worst outcome for next year would be if we really run into a type of recessionary environment on top of all the other fundamental aspects we discussed. But let's stay optimistic and look on the near-term future that looks pretty bright.
Only one invitation, our JBC Energy Matters seminar. Many of you I know have been there. We do it now for the third time this year. A 2-day hardcore fundamental analysis. Really good stuff. We also do this year some courses, energy trading, risk management, pricing done by this guy and another guy doing analyzing oil markets. So if you want to use that for some of your junior colleagues to get them up to speed. Now that concludes our presentation. Thank you. I haven't seen anyone running away, so it must not have been that bad, or you are asleep. Now, or it was good, and I thank you for that. Open for question, please.
Thanks a lot for the presentation. Very interesting. I just had a question, slightly random. Do you think that we could see any delayed tier 3 sulfur impacts in the US refining sector over the course of the next year? Over the last, let's say, 5 years, they've accumulated a lot of credits, tier 3 credits. There's really quite a few of the earnings reports in Q4. And they did, there were quite a few mentions of, we haven't seen tier 3 yet. And given that this is also happening as we go into IMO 2020, do you think this is potentially an issue? Or do you think that, if I go back to the sulfur levels we saw end of 2017, we're talking maybe 22 ppm. So nowhere near the sort of 10 ppm level. So it'd be interesting to know what you think about that.
I take that question. Generally, I know that's a thought that has been in the mind of many people, but I would say all the marginal changes we see in the industry, in the US industry specifically as well, crude getting so much lighter and with that also so much sweeter. Also, if you take our forecast into account that probably crude runs will not be maximized to the full limit for this next 1 or 2 years, we would be surprised to see a significant issue on the sulfur side on gasoline. Yeah? So for individual players here and there or in local markets, there could be an issue, but generally speaking, for the entire market, we don't see that as an issue.
Okay, another question, please.
No questions left open.
Well then, thank you very much for coming, and please enjoy the coffee. Sorry?
Thank you very much.
Yeah?
Yeah.